Well, good morning, everybody. It's a delight and a pleasure to be doing one of these in the morning for a change. And I know a number of you are listening from parts of the world where in previous episodes you might have been listening late at night. So delighted to welcome you, and thank you very much, Nick and the team at Reask, for your support for what I know is going to be a really fascinating discussion. We've got some excellent panelists here, and I actually feel very well qualified to say that, as I've worked with everybody here, either as a colleague or as a client. So for those of you that haven't joined us before, and we had 363 registrations at the last count, just a quick little bit of logistics. You can see we've got half our panelists on screen for now. We'll be coming and joining the other three later in the day, or later in the morning, I should say. If you've got any questions, please do post those. You'll see on the right-hand side of your screen, you've got a question mark, and we do like questions. We've got a number of discussion points for our panelists, but we always like to keep this live and real, and we will pick your questions up during the course of the event, so please drop those in for us. Some of us are dialing in from parts of the world where the internet is a little bit flaky. It includes London, so if any of us disappear, please do hang on. We will come back, including myself. Please don't lose us. So far, we've managed to bring everyone back on course, and I think with that we are ready to go. So just to introduce my first three guests, first of all, Nick Hassan. Nick is co-founder and chief commercial officer of Reask. Nick, good morning, or I guess good afternoon, as you're now based down in Australia.
Yes, very early evening, and thank you very much, Matthew, for hosting us today, and obviously to our panelists and the audience as well for tuning in. We really appreciate it.
Excellent. And then Dr. Jessica Turner. Jessica is managing director, Catastrophe Advisory from Guy Carpenter. Jessica, good morning for you. I think you're calling in from the UK.
Thank you. Pleasure to be here today.
And then finally, Richard Dixon. Richard is doing consulting work, but also is head of catastrophe research at the newly formed Inigo Insurance. Richard, great to see you.
Good morning. Happy to be here.
Excellent. So let's kick off with Nick. So Nick, people think about climate change impacts over different time horizons. You know, the debate today is really what are the decisions that people are making today that are going to be impacted by both longer term climate, short term climate, and seasonal forecasting. And we're going to talk a bit about what those mean, different interpretations of them. But when you are talking to your clients, what are they looking for you to help them give advice on or get advice on they can use in their decision making in the sort of short term?
Yeah, absolutely. And I think you've really sort of encompassed, I guess, the broader context of this conversation in that question in, what are the various timescales that we're looking to really understand catastrophe risk and in our example, tropical cyclone risk. What are the different sort of temporal periods that we're interested in? And we know that, in the insurance industry, there's, this traditional sort of 12-month period, which also aligns to some extent with a sort of an annual season for tropical cyclones in different hemispheres. And what we see increasingly are that organisations are keen to understand how it is that risk is changing over those different time periods. Certainly back when I was on the underwriting side in the Lloyd's market, that we had this sort of annual renewal process, which we go through and price out risk over a 12-month period. And I guess my experience in that time was that, that led us to having a focus on this sort of annual refresh of our view of risk. But what we know is that, climate variability, or the way in which the climate actually changes at different temporal periods. So whether it's an annual or a seasonal basis, whether it's multi-decadal for different climate oscillations or otherwise, but even within individual seasons, we know that there are changes in the variability. And I think probably one of the best ways to sort of explain that is to use a sort of a demonstration. And we're, I guess, in some ways unlucky, but also fortunate to have last year's very active season, as most of you will know, in the North Atlantic, one of the busiest seasons on record. And that is something that's sort of given us a really good opportunity to understand how that climate variability changes within the context of a season itself. So as an example, example, last September, we had a clear La Nina signal. And in running our sort of methodologies and machine learning processes, we forecast, as an example, a 30% increase in the probability of a Category 2 hurricane for landfall in a section of coast along the sort of Louisiana-Florida border, which happened to be right where a Category 2 Hurricane Sally came along and made landfall a few weeks later. So this sort of dynamic information gives us the insight to sort of make decisions on how that increased risk might impact the exposure that we're carrying. And the way that we deliver that information is we provide that probabilistically, which is just what we would do when we were initially pricing or selecting risks to write as part of a portfolio. So what we can do is we can consider the variation in climate in that particular instance on a monthly basis, so we can understand how the climate is varying throughout even an individual season on a monthly basis. We're lucky to have access to information that is updated on that regular basis. So with that information, obviously insurers can do a variety of things. We can look at things like embargoes, backup insurance covers, and other forms of hedging. And that really is, or alternatively, if we have a sort of a reduced risk, we might consider what options we have to extend and capitalise on opportunities that present themselves. It really then comes down a great deal to what it is that the organisation is trying to do and who the organisation is, and we'll hear from some different parts of the market today on their interests. But I think our perspective is that whatever way you want to look at it, the key for us is to move beyond this sort of static approach and allow the short-term climate trends to sort of inform us on what our view of risk should be. And when I say static, what I'm talking about is that existing probabilistic modelling solutions, they would assign the same likelihood at any point during an individual season, and indeed for the lifetime of a model, which could be over many, many years. We've certainly seen models that have run for 2, 5, 10, even 15 years at the extreme, despite the variation in climate in that time. And that's where we think that the real advantage of really understanding climate variability really comes into play.
Great. Well, thanks, Nick. Well, there's a lot in there. For those
Yes.
who want to get a bit more, and we'll be asking a couple more questions, but we did, I'm going to say it's excellent, which might suggest that I had a lot to do with that. But the excellent podcast you and Thomas did, I've had lots of great feedback on that, on what you're doing, and expands on that a bit more. But there's some key points in there we're going to unpack today around the ability to actually take the established catastrophe models and take account of some of that more short-term view of risk and the climate trends, and also I think your point earlier about being able to do those forecasts mid-year. And I know when we talk to Jessica and Richard in a minute, we're going to hear a little bit more about how they think about some of the short-term decisions and the difference between climate change and natural variability. But just before we do move on, we've got a great range of organisations we're going to hear from today. Just in a minute or so, can you just give a sense as to why you've brought together this group to talk about this topic?
Yeah, I guess, the panel that we've assembled today, I guess a bunch of experts that we at reask have a great deal of respect for and have sort of been in conversation with over not just the time, the very brief time that we've formed reask, but over a much longer period of time, my own experience in the market for the last 18 years. So, I think our goal in bringing together these experts is really to expand and extend the conversation on what is important for insurance organisations to understand. So, for example, we have Jessica, who's working for a reinsurance broker. Richard obviously has experience on the insurance side across a number of different organisations, and we'll speak soon to Marcus on the ILS side, as well as Kirsten from Lloyd's. And I think our goal there really is to try and get a different feel for how it is that those different organisations can utilise the types of products that we're developing, and I guess help to drive the way in which we develop these tools, the research that we're doing. Because at the end of the day, we're driven by what it is that the market is keen to see in terms of understanding catastrophe risk, but that's not one concise view. It's different for different segments of the market, and in reality, it is as unique as each individual underwriter or intermediary is in terms of the way that they approach risk transfer.
Great. Well, congratulations, Nick, on growing the business so well in a number of years. I saw you right at the beginning there, and I know you've got some other sort of quite large marquee insurance relationships as well. So with that, Jessica, over to you. I mean, part of your role is advising Guy Carpenter's clients on, capital protection, reinsurance buying. Climate change, in the broader sense, has been an issue for a while that people have been taking account of. But as you start to think about decisions they're making in the short term, by which I mean the next 12 months, what are you hearing from them about the kind of information they need and the help they need from you for the decisions they're making?
Yeah, sure. I mean, I in my role, I do advise clients about their risk assessment on multiple timescales. So as you mentioned, it might be a 12-month timescale, if you're talking about a reinsurance contract placement, but all the way up to, longer term advising if they're trying to do things like evaluate climate change for disclosure and regulatory purposes. And I think Nick is absolutely right that you need different tools if you're looking at different time horizons. And each of those tools have their own nuances and their pros and cons and things that you need to understand about them. I mean, in terms of the short term, which is what you asked about, I think it's really important to understand that on a year-to-year basis, natural variability is swamping any kind of climate change signal that there is. So the large swings in losses you'll see, I would argue, is really natural variability. Now, that said, there is a large body of work called Attribution Studies, where climate scientists use climate models to look at individual extreme events that occurred and to say how much more likely were they because of climate change. So some examples would be the Australian bushfires or the California bushfires, for example. Storm Desmond in the UK, I think there was a study that said it was 60% more likely compared to pre-industrial greenhouse gas loading. So you've got a balance between natural variability, but also obviously there is some impact that climate change is having on kind of loading the dice, if you like, for some perils in some regions. However, I am seeing a tendency for the news media, every time there's a big event, to jump on it and to say it's climate change. And it's not always. A great example of that is the recent Texas winter storm. I think a lot of people came out of the gate saying, oh, this is more likely because of climate change. And I saw climate scientists in my community trying to say, hold on, we're not quite sure that that's the case.
Yeah, no, it's a really important distinction in there. And if you look at this sort of decisions people are making in the 12-month period, I mean, in the sort of traditional insurance world, most insurance contracts, reinsurance contracts last a year. But with that increasing trend, are people starting to take account of what's happening sort of longer term in their annual views? And we'll talk separately about when you start to get into short-term seasonal forecasting, but just that longer term trend, are they actually able to do anything about it and doing anything about it? Or is it a sort of problem that seems to be out there in the future and disconnected from insurance buying decisions?
I think it is starting to be taken into account. I mean, I get asked all the time, well, okay, how do I incorporate climate change into my business decisions? And I think it is a tricky one. And depending on what your risk appetite is or your attitude to the issue, you might take different choices. But one thing you could do, for example, is if you calculate what you think your risk is in 2050, the change in your AAL. Let's say you think your AAL is going to change. Maybe it's going to increase by 20% by 2050. Well, annualized, that's 1% per year. So you could consider doing things like charging 1% more per year in your prices, or trying to slowly rebalance your portfolio to get away from some of that risk. So I think doing the calculation in the medium term does have benefits for your decision-making on the 12-month period.
Great, and we may come back and talk a little bit about ESG, the environmental societal governance attributes, and also TCFD, which I'm going to have to make sure I spell that out correctly, but the Task Force for Climate-Related Financial Disclosures reporting requirements that are out there as well. But Nick mentioned the work they're doing on this seasonal forecasting, and we're going to hear a bit more from Richard in a minute. But what is your view on where we are today in terms of being able to use information from organizations like reask for helping people in that really short-term guidance? Is that getting better, and can people start to use that with some confidence now?
I think, previous to being a Guy Carpenter, I was working for a primary insurer in the underwriting team. And I think from my perspective, what immediately seems useful to me is from an operational perspective, because it would be really useful at the beginning of the season to know, well, how many claims adjusters might I want to hire? Should I renegotiate contracts for some of the rebuilding, which I know is going to need to be done? And I think the operational benefit is obvious. From a reinsurance perspective, it's always been slightly more of a challenge because our renewal periods are slightly mismatched to when you get your most skill in terms of seasonal forecasting, particularly if you're thinking about US hurricane. But I don't know that that's not a challenge that couldn't be overcome.
And there's a time period, isn't there? I mean, or a period in the year which you can have more confidence in hurricanes. And actually, perhaps you'd also just say, for those who aren't familiar or aren't sort of aware of the distinction between the hurricane, the creation of hurricanes and forecasting landfalling hurricanes, obviously a very important distinction in there.
My understanding is it's an easier project to forecast what your basin numbers might be, because that depends on things like the ocean heat, INSO signals, which is relatively easy to predict. But if you're talking about landfall, then you're talking about steering flow, and that's my understanding is that's much harder to forecast on a seasonal basis.
Great. Well, thank you. Don't go away. We'll come back to you in a second. But that's a good segue to Richard. It is your I guess I wouldn't say your pet topic, but it is your topic. It's what you're there for. So just coming in with that question around, we talked a little bit about this annual variability of climate versus the sort of overarching trends around climate change. But can you just give us a sort of perspective for people on how you see the distinction between the sort of macro effects of climate change and the seasonal variability?
Yeah. In terms of climate change, I often try and see it as a steady background drift in a way. And as Jess has already mentioned, when you look at season, that's just dominated by a season ahead will be dominated by natural variability, like things like El Nino. The one thing that I also find fascinating is the link between the two, whereby climate change, their thinking potentially might make El Nino and La Nina seasons more vigorous potentially, which could then have a feedback into the seasonal noise. So that's a pretty interesting one. But whether or not, I think one thing for me that bothers me the most is whether or not you're dealing with the season ahead or looking at climate change in the present day, is just making sure your model accounts for the present day risk, not 20 years ago. The prime example being hurricane. We're kind of in a warm sea surface temperature period where traditionally we see the activity being up, down in correspondence with warm and cold seas. Well, the latest science suggests it might not necessarily drop back down to a colder spell like we had in the 70s and 80s. So if your view of risk is taken into account going all the way back in time, potentially the new view of the science suggests that we should only be concentrating on the present day to inform our risk that looks ahead for the current season and looks ahead for the next 10 years. So if we think about the next 3, 5 to 10 years, again, I feel as though if we've got our baseline set correctly for today, it's going to cope with the next 10 years pretty much okay, I think, in terms of climate impacts. But I think, again, we can discuss about whether or not this varies due to peril specificity. So it might be okay potentially for European windstorm, but 10 years down the line, we might have a different view on wildfire to what we have now. We can see how much it's changed in the last 20 years. So whether we think that should be static for the next 10 years is another thing.
So I just want to make sure I understood that last bit correctly. So you're saying that the primary focus is on the short term, or more a decade of hurricane activity, where there's less emphasis should be put on the more historic trends. Is that how you describe it?
Well, that's how the science emerging makes us suggest that we should be thinking. Yeah, just because the models have been built traditionally on warm sea, cold sea, and a long view that takes into account both of those, or you can pick the warm sea surface temperature view. But the warm seas now aren't the warm seas of the 1950s. They're ticked up by about 0.5 degree. So that's what worries me in terms of making sure you've got your present day view of risk correct.
And I mean, you've had the benefit of seeing this over about 20 years of your career in insurance and catastrophe modeling and working for reinsurance companies. How much more confident do you think we have now about this ability to look at the seasonal variability and the seasonal forecasting? And even if we're doing it as late as June, relative, if you can remember that far back, 20 years ago when you started.
Yes. Well, 20 years of research is a heck of a long time. And if you just look into forecasting, just the research that's gone into it and the models that are being built, the resolution of the models is probably, I don't know, twofold, threefold, fourfold of what they were in 20 years ago. And typically you'll see on a weather forecasting basis, the quality of a 7-day forecast is the same as that of 5 days 20 years ago, which is, I know it's not relative to seasonal forecasting, but you can see that what strides have been made since then. And if you just look at things like the Colorado State University forecast, you contrast what went into it then to what goes into it now. They're using a lot more dynamical forecasts. So we're actually weather forecasting about 6 months ahead as well as statistical forecasting, whereas 20 years ago it was just statistical forecasts. And one example, I always look at the Ecmwf forecasts. They run 51 forecasts at the start of the year. And last year in April, they were, much like Nick was talking about for their forecast, they had the Gulf of Mexico was glowing, in terms of the how anomalously windy it might be. And I just thought, well, that's interesting. Didn't think anything of it. And I was reminded of that later in the season. So it's one example there of what we can do now in terms of forecasting. But undoubtedly, the quality of the forecast has improved. And also just the number of forecasting agencies are there. If you look at the Barcelona Supercomputer Center website, you'll see 8 or 9 forecasts there lined up from April for the rest of the year. And they're all of them are saying it looks like it's going to be a tick above what the average should be for this present state of climate.
Great. Nick, I'm going to come to you in a second on that, but I can't let you get away with that long acronym there, which I can't even remember. So you mentioned somebody doing the forecast with lots of...
Sorry, yeah.
Say that again.
The European Centre for Medium Range Weather Forecasts. Okay. I apologise, I've gone into the vernacular straight away.
That's great. This helps me. And Nick, before I come to you, just for our listeners, we'd love to get your questions. I've got lots of questions for the panels, but yours are going to be more interesting than mine, I think. So please do start putting them up there so we can bring them in. So Nick, just back to you before we transition to the next session. Lots of information out there. Richard mentioned a number of the forecasts out there. You've got to take what exists, turn that into a product, provide it to your clients. How do you aggregate all of that active variations in the forecasts and actually provide that to people so they can actually make some true decisions out of it rather than maybe being blinded by all the different choices?
Yeah, absolutely. Look, I think across all our solutions, and we operate across both sort of long-term probabilistic views of risk, so 100,000-year simulation. We do a lot of event response analysis as well, so responding to tropical cyclone events as they occur, and then obviously we have our sort of seasonal and sort of climate trends product vertical, where we're looking at either the upcoming season in terms of what our expectations of frequency and severity are. So in terms of how those sort of products are used, what we do is a lot of the way that we work with organisations is to try and incorporate or augment their existing framework and enable them to, incorporate our information into their existing workflow and the framework that they currently use, because that makes things much more straightforward for them and enables them to sort of, I guess, add another string to the bow in terms of the information that they're consuming. So an example of that is to look at relativities. So if we were to look at a comparison of, say, our long-term view, our 100,000-year simulation view, which is a probabilistic view that we have globally, and, for example, our seasonal view, if we took that example I mentioned before in the sort of the Florida, Louisiana coast, if someone wanted to understand what the risk of a Cat 2 landfall along that section of coast was, the first thing we do is we'd look in our long-term event set and have a look at what our 100,000-year probabilistic view is giving us, and then compare that to our seasonal view that is actually accounting for the latest climate trends, so what's actually happening now. And obviously the ratio between those two rates can then be seen as a correction factor that you can then apply to an existing framework to turn the static rates into seasonal ones. So effectively what we do is seasonally adjust those long-term views of risk. And although I sort of have mentioned the sort of the seasonal views as well, we can obviously take the same approach and look at the ratio, say, for example, between the long-term view and, say, for example, 2020 to 2060 or 2060 to 2100. So we can look at future climate variability as well. But the goal is to try and provide our products in a way that enables organisations to consume them in the context of their existing views of risk, and to sort of add and augment and supplement those views to give them that extra understanding of how it is that the current climate variability is impacting the way in which they transfer risk.
Fantastic. Well, we've got questions coming in now. We're just going to eat into the next panel a little bit because you've got a bit of time. Nick, I'm going to ask you this question, and as the co-host, you are totally permitted to deflect it to somebody else if you don't know the answer, because I have no idea what this means. So maybe it's a typo, but let me try it. So the question is, how does modelling capture the exponential fastening of climate change? Do you know that, Nick?
That is it's an intriguing question, and probably one that's very important, almost certainly one that's better answered by my colleagues on the panel. I think the only thing that I would say, which was something that Jessica mentioned before, is that it's important, and Richard mentioned as well, it's important that we actually consider in the first instance what has happened to date. So what experience of climate change have we actually incorporated into our models as they stand at the moment? And the only real way that we feel that that is possible is through the real capturing of climate variability. So do we understand exactly what the potential variability of the climate is at this point in time? And in fact, Lloyd's, and Kirsten can comment on this later, but Lloyd's, as an example, as part of their sort of exposure management process, have stated that they want all managing agents to ensure that their catastrophe modelling processes incorporate all impacts of climate change to the current day within their CAP modelling process. In fact, they're to some extent less concerned about the future risk. That is still a concern, but that's put to one side to ensure that organisations, encapsulate what has happened to date. But other than that, I don't know if Jessica or Richard want to comment.
Well, I might hold it there. I think I've just actually worked out what that question means. It actually means exponential increase, speeding up of climate change, isn't it?
Yeah.
Because that's kind of good. Well, listen, we'll pick it up later on. We've got a lot more questions coming in now, so I want to make sure we get a chance to speak to the next three, including Kirsten, just referencing back what you said there, Nick. So many thanks. Going to ask our the three of you to drop off now, and let's see if we can bring the others onto our virtual stage. Thank you. Fantastic. We all got here. Lovely to see you all. So first of all, some introductions. So Marcus Valdi, CEO and head of ILS, that's Insurance Linked Securities, Credit and Equity Analytics from 12 Capital. Marcus, hello.
Good morning.
Great that you could join us. We've got Dr. Kirsten Mitchell-Wallace. Kirsten, known to many of you, head of Portfolio Risk Management at Lloyd's. Kirsten, very, very pleased to see you here to take some time out. I know it was a very busy time for you. Thank you for joining us.
Well, thank you for inviting me, Matthew.
And then finally, another very well-known figure, Dr. Matthew Jones, head of Catastrophe Risk Products at Nasdaq. Matt, great to see you.
Hi, Matthew. Hi, everyone. Yeah, it's great to be here.
Fantastic. Okay, well, Matt, we're going to start off with you first of all. You've got such a great broad perspective of being an actuary, working in an insurance company, running exposure management, and now part of Nasdaq. So you're now looking at some you have been for a long time, very practical ways of taking the information that organizations like reask and others are using. How actionable do you see that for an insurance organization, whether your clients or your past experience?
Yeah, thanks, Matthew. Yeah, I think it's I think the information that reask are producing is really interesting and should actually be really useful to an insurer or a reinsurer. I wouldn't tend to use this sort of information to alter the price of a primary insurance policy. I think changing the policy price year on year based on seasonal forecasts would make you pretty unpopular with the policyholder. But I do think this sort of information can actually help in a number of situations. So, for example, if you're an underwriter deciding whether or not to buy facultative reinsurance, so that's a specific type of reinsurance specific to a policy or to a risk. then this could be a useful piece of information that could sway your opinion on maybe whether or not to buy FAC or how much FAC to buy, what kind of FAC. So I think seasonal forecasting, absolutely, if the timing is right, can help you with that sort of decision. If you're in a subscription market, like much of the London market, where people, instead of taking all of the risk, take a share of the risk on a particular policy, then of course this type of information could influence whether or not you want to increase or decrease your share of that risk. So those are, I think, a couple of examples where this sort of information could help. To take a slightly different example, if you're a reinsurance buyer for an insurance company, or perhaps if you're a retrocession buyer for a reinsurance company, now you're likely to have your core reinsurance programs in place, in my experience, that, you know, year on year they do change a bit, but they're largely similar. And I wouldn't see this impacting that too much, but you're also likely, in my experience, you're likely to have some facility to put tactical reinsurance in place, or reinsurance that varies a bit year on year. You're likely to have some flexibility to do that. And I think that's where this can really help, because I think Jessica mentioned the issue of renewal dates not matching up properly with seasonal forecast skill. But of course, if you're thinking about tactical reinsurance, you have more latitude about when and how to buy that and what sort of reinsurance program to buy. So I think this sort of information can help with that. Perhaps also flexing co-reinsurance shares on the program to take more or less risk, depending on the forecast. So, I mean, clearly it does depend on how good the skill is and when that skill comes and how that intersects with renewal dates. But I do think there is a lot of opportunity to use this information in a variety of ways, yeah.
Great. Well, I'm glad we're recording this and going to be writing it up, because there were lots of great detail in there. For those that aren't familiar or aren't in the insurance world, we mentioned FAC earlier on. So that's a facultative reinsurance, which is basically the reinsurance on some of the larger accounts that people are underwriting. And now with Nasdaq, you've got an increasingly large number of models you're making available. And, you know, thank you for your support. We've talked about a few of those on these discussions before. How do you see this ability now to do some more of the seasonal forecasting, you know, being able to sort of integrate or link into what you're providing with what the models that are sitting on the Nasdaq platform?
Yeah, so we have a platform that we can host OASIS-based models. We have 12 different vendors and 300 country perils on the platform already. And of course, we'd love to have a catastrophe model by reask on the platform. I'm sure in time, and I hope that will come. I think one of the reasons I like the approach that reask has taken, that we mentioned seasonal forecasting, but actually, as well as that, they're taking a very global approach, I believe, in terms of the way they're looking at the risk. And I do like that. I think that's a really positive thing. So not sectioning off one region at a time, but actually trying to understand the global nature of risk as it relates to tropical cyclone or other atmospheric perils. And I think that's a pretty important change compared to what we've seen before. I mean, we do already have a global probabilistic flood model on the platform. It'd be fantastic to complement that with the global tropical cyclone model. And I think part of the reason that that's a really important thing relates to how insurance companies or reinsurance companies manage their catastrophe risk. I mean, if these companies have catastrophe risk, ultimately somewhere in their risk policy will be a statement about how much risk they are prepared to take as a company. And when you try and calculate how much risk a company is taking to compare to that risk policy, very often the way companies do it these days is to look at these regions in isolation. So you might look at North Atlantic hurricane risk separately to Japan typhoon risk and so on. And then you treat these as independent regions when you sort of add them all up. You recognize diversity, but you do treat them as independent regions. And I think the ability to look at the risk globally brings a new dimension to it. You can actually, if there are relationships between these regions, you can start to incorporate those and how you calculate how much risk an insurance or a reinsurance company takes compared to what is there in the risk policy. So I really like the global nature of risk, and I think that absolutely is a differentiator compared to what's been done in the past, and something I like about what reask are doing.
Brilliant. Well, thank you. Well, Matt, we'll come back to you in a minute. And thank you to all of you for your questions. They're now being deluged with questions. Please do keep them coming in. I can't promise we'll get to all of them. Probably focus on the ones I can understand. And but we will get the other ones answered. But I just want to transition now. Marcus, Marcus, thanks for joining us. You've got a different perspective, let's call it, coming into this as an investor in catastrophe bonds, one of which, of course, you've got a longer term view in many cases. So you're just specifically, thinking about what you're doing, what are some of the sort of challenges that you have when you make decisions now with regards to things that might play out over a longer term?
So I guess, we're always trying to improve, our understanding of risk when we're making our investment decisions. And I think if we rewind a few years ago, before we started working with reask, there were, I think some clear weaknesses, shall we say, in the traditional hurricane forecasting approach on a seasonal basis, where the focus was mainly on hurricane count. But in our view, that was not necessarily a great predictor of loss. You can have seasons where you get a large number of storm counts, but actually not much in terms of insurance loss. And last year, a year off the charts in terms of number of count of storms, 30 storms, but relatively few landfalling events. And we wanted to find a way to really make that forecast view chime and really tie in more closely with what we're trying to do, which is to put investors' money to work in an efficient way to generate attractive returns for them. So really, we needed to address this weakness in traditional forecasting approaches, and we wanted to enhance that, and hence our work with reask. And really, the big changes that we've been really looking to do there to enhance the work is not just looking at storm count, but also think about landfall probability, and also to think about genesis location of hurricanes, where they form. We believe both of those items are very much more important and useful when thinking about risk from a portfolio construction process perspective, either in insurance-linked securities or in insurance equities.
And what about the sort of short versus long-term impacts? I mean, you tend to be investing for the longer term that has it. So we've talked a bit about what is long-term and climate change, but you've got, when we were talking before, you mentioned you've got some investments that are structured over 10 years. So for you, it's slightly different than a traditional insurance organization that just has a 12-month horizon.
Yeah, so 12, we're an asset management. We purely focus on the insurance industry, and we have different funds investing in different types of products with different investment horizons, as you say. So catastrophe bonds, relatively short duration investments, equities too, and liquid as well, so you can trade in and out of them. Whereas we've got private debt investments that we make, which may extend over a 10-year horizon. So you could argue climate change is more relevant to that sort of private debt type investments, and annual variability is more relevant to equity and ILS. In terms of how we think about this, though, the great thing about these sort of shorter term and shorter duration type of investments is the ability of the industry to reprice on a very, very regular basis. And we see that every year, annual renewal seasons come about, and an ability to reprice and reposition portfolios accordingly. And clearly we're seeing an upwards tick in pricing for reinsurance and insurance risk. Natural catastrophe loss activity, I was going to say climate change, but what we've been seeing more recently is one key driver of that. There's lots of other things going on as well, but pricing is absolutely on a clear upwards trajectory at the moment, which means better margins for investing going forward. When we think about the longer term view, and again, my work with reask has not just been about that seasonal forecast, it's also about trying to understand how that hurricane peril may evolve over time out of another 40-year period because of climate change. There what we're really seeing, I think the punchline is, for us, is that the heightened level of activity we've seen over the last 20 years and the volatility around that is probably going to be the new normal over that next 40 years. And so as a result of that, it really bodes well in terms of the reinsurance industry needing capital market involvement to help them take on that peak peril risk, and it can't do it all on its own, which bodes well for the longer term future for the ILS asset class, and also of course the return potential available to it. And I think it also ties very neatly into the ESG agenda, and we'll maybe talk a bit about this, but ESG investors want to put money at work to support transitions that are necessary in the global economy, and also to support resilience in society as the world transitions through this climate change that we're seeing. And again, insurance for us plays a real key role in doing that, and is a big part of the offer to investors that insurance plays a central role in supporting, you know, that dynamic.
Yeah, no, I think we will. If we touch that later on, if not, we'd definitely be interested to do a follow up on the whole ESG drivers, because there's so many different aspects to that. The sort of positive side of it, in a sense, is bringing more money into funds, particularly insurance, where arguably is helping reduce the impacts of climate change, but also the whole regulatory side. Well, Marcus, we'll come back in a minute and pick that up. Just want to transition to Kirsten now. Kirsten, thank you for your patience. We've definitely allowed enough time to hear what you're doing. You also bring another great blend of experience into this. You've been a modeler yourself. You've worked in a reinsurance organization. Now you and your team are performing some very important work at Lloyd's in terms of oversight on what the various managing agents are doing with their capital underwriting. But can you just talk sort of briefly about what you're doing in that area, and then we'll sort of transition a little bit to talk about the climate variability aspect.
Sure, I can. I've got to apologise because I seem to have turned into a ghost, which I think has got something to do with, if I hold my hand up here, you can see me better, but just bear with me.
We can hear you fine. So
it's not very sunny out there. So yes, I obviously work at Lloyd's. My team's portfolio risk management is called. It has a pretty broad scope. It's exposure management, outwards reinsurance, aggregation, pricing, portfolio management, and research. And I think the bit we're most interested here today is the exposure management and the aggregation piece. What we do at Lloyd's, our purpose is sharing risk to create a braver world. And the purpose of my team is really to make sure that that sharing of risk is that we manage the risks and the market is sustainable so that we can continue to share risks. We look at cat risk. Well, the mission of our mission is to understand and control catastrophe risk at a syndicate level and for the market as a whole. So to do that, we do that in a couple of ways. We have our very famous realistic disaster scenario framework. We tend to use that now for more non-nat cat. And we also collect probabilistic risk representations from all of the syndicates and stitch those together at a central level to get an overall Lloyd's view. And as well as doing that, we also look into how the modelling is done and the exposure management functions within the organisation. So all of this together determines how we consider the risk and how we view the CAT component of the business plans which are presented to Lloyd's.
Thank you. And Lloyd's itself has come out and shows some leadership in terms of choices it's going to be making around some of the areas it's going to be underwriting. But I know also you are continually evolving what you're doing with the RDSs. As you said, they're now less focused around the natural catastrophes and you're using more probabilistic areas. How do you start to take account of well, let's start with the seasonal variability first of all. So is that something you're trying to get an opinion from when people are reporting to you, or is that just too difficult to do?
No, so the seasonal variability isn't, and that really picks up on, I think, the points that Matthew was making earlier about its use in the insurance and reinsurance market, and probably that it's a little bit more, the reinsurance purchase more of a long-term thing related to the minimum regulatory capital requirements. And I think that, the short term, it's more about underwriting decisions or making specific decisions in marginal cases. That information would be very useful to help you make that decision, but it's not an overall determinant. So we're not looking at seasonal forecasting.
Okay, no, that makes sense. And then just thinking about your continual evolution of the way you're looking at impacts, are you sort of looking at doing things like stress tests now to sort of look at potential scenarios and outcomes and seeing how those could impact the different organizations?
I mean, yes, but I think it's very important here to separate the two issues between climate change from a strategic perspective, which Jessica was mentioning earlier. So, what does this mean for what we might want to do in the longer term, or as relevant from Marcus's side on the, related to assets, to what is the risk we have now. and picking up on what both Nick and Richard said, we really want the catastrophe modelling that is done within Lloyd's to be appropriate for the current climate and to reflect changes in climate which have already occurred and might be influencing the hazard now and over the time frame by the policies which are underwritten, which, as you know, is usually a year. So we updated our capital guidance to say that last year. Of course, capital guidance has lots of things in it about stress testing and the board understanding the financial risk from climate change, etc. But that's the bit I think that's kind of really relevant from an oversight perspective.
Great. And many organizations around the world look at what Lloyd's is doing, and indeed, what your own team is doing, as some of the examples of best practice in this area. Where should people go to learn more about what you're doing? Is that publicly available information, or how would they sort of learn about it?
It's not at the moment. I suppose what's worth mentioning is what we're going to be doing this year is a thematic review. So a thematic review in Lloyd's is where we speak to lots of different managing agents and find out what they're doing on a specific topic. And then out of that, we distill recommendations and best practice and publish that for the market. And then usually we tell people about that at conferences, etc. So this year, we're asking 10 syndicates what their methodologies they have for making sure that their current risk is up to date. And when we finish that, we share the report with all of the managing agents. This is what we found. These are things that you could consider doing. This is what we consider to be best practice in this field. So it's available for managing agents, and usually we talk about it a bit more widely as well.
Okay, fantastic. Well, thank you, Kirsten. Please do stick around because we've now got some time for questions from everybody. So I'd like to just invite our panelists back onto the screen, and we will now start working our way through all the great questions that came in, and can throw away our prepared questions in the unlikely event we didn't have any from the audience. So I hope you're all on your toes. I would say fingers on the buzzers, but you're going to have to allow me to direct the questions to you. So let's see who we've got. Waiting for Jessica. Okay. Well, fortunately, our panelists can read the questions, so I get the choice to just allocate these. Good. Okay, we've got one on TCFD. I still can't memorize that one. Task Force for Climate-Related Financial Disclosures. Jessica, I'm going to come to you on that one in terms of, from your point of view, when you're advising on your clients beyond obviously the reinsurance buying. The question here is, to the extent, what are the implications of that for insurance organizations? It might be worthwhile if you could just explain a little bit about what TCFD is. And the specific question is, the biggest risk facing corporates over the next 5 to 10 years come from what are known as transition risks. Do you think the insurance industry has a role to play here in helping corporates manage this transition? Actually, I should have asked Jessica. She's not back on screen. So let me pass that to Matt. Do you feel you want to be able to talk a bit about TCFD and transition risk?
I'm muted on site. Yeah, absolutely. So I think the TCFD put out a really instrumental report back in 2017. And we're just seeing really the outcome of that report starting to manifest in terms of the guidances and the recommendations that are coming out now on a country by country basis. And the UK Bank of England BES is part of that. I think transition risks, absolutely. I think the insurance industry has a part to play in that. I think what's important to recognise is there is an interdependency between transition risk and physical risk. If there's large transition risk because things change a lot, the physical risk is reduced and vice versa. I think obviously CAT models and the sort of information that reask have is largely focused on physical risk. So that's where I think it can help out more. But because there is this interdependency, I think the insurance industry should be able to help out with both.
Excellent. And then, Marcus, we touched on this a little bit earlier on for the investor's point of view, but there's another question in here as well. Maybe you can sort of blend this one into this. But is there an opportunity from climate change? And Richard, stand by, because I've got a question for you related to this as well. Is there an opportunity from climate change in a positive way for the industry? And is that, whether through regulation or just different awareness or even some positive changes that sort of you're seeing factoring into how people are investing in this space?
Yes, I think absolutely the potential is there. What I would just say, though, to the insurance industry, if I can, is that the disclosure requirements, we're under huge pressure at the moment from lots of different regulatory sources to talk to our investors more about the risk to our funds from climate change, and also the role that our funds are playing to promote and support a positive change that's required in global economies, so promoting environmental or social changes that are necessary. And at the moment, I've got to say that the push to disclose from our side is running much faster than the industry and general corporate land out there is doing in terms of disclosing exactly what they're doing. So at the moment, there's a lot of criticism, I think, that can be leveled at many industries, including insurance, around the quality of disclosure on environmental and social risks. There's a lot of discrepancy in terms of geographically how that's coming forward. So Europe seems to be much more forthright in stepping up to talk about this, say, versus Bermuda or versus the US. And the insurance industry itself is very happy to talk about, what they're doing at a corporate level, how many, plastic bottles they're recycling and what they're doing on the investment side of the portfolio, but very reluctant to talk about what they're doing on the liability side of the balance sheet, which ultimately that is the key decision that investors are coming to the insurance industry for, to, what are you doing with your underwriting when it comes to, managing climate risk, but also, engaging more broadly to help drive positive change. So there's a lot, unfortunately, that needs still to be done. The insurance industry, as I say, potentially has got a huge role to play here and is starting on a relative basis in a good place, we would argue, versus corporate land generally. But absolutely, a lot more needs to be done.
Oh, well, thank you. So, Rich, just coming to you now. I know when you've got a view related to climate risk generally, that it isn't necessarily just a one-way street. It's not necessarily all bad, or it shouldn't be necessarily seen as being more... climate means greater events causing greater losses.
No, I think Jess touched upon that earlier. We tend to get fed by the media or by politicians potentially the mantra that everything is getting worse. There's going to be hazards where risk might be flat or geographically it's shifting. So some areas might see an increase in risk, decrease in risk. I mean, I was looking recently at the Cordex experiment, which is, as it sounds, CORDEX. They've got some really interesting stuff for Europe wind, and they're looking at losses out into the future for the various different pathways, so the warming pathways, and there's very little change in the wind risk there. So we have to be pretty careful. And secondly, we're also in a position in our industry to be able to talk through the change in risk through multiple lenses. Typically up to now, we're talking about in 20, 30 years' time, we're going to see a change in risk due to this change in hazard, without even thinking about how exposure and vulnerability are going to change. And, if you look at how the vulnerability has changed in Florida in the last 20 years with changes in building codes, applying that to the future would be very useful to see how things are changing. And myself and Tom Philp from Maximum Information have got a little group together where we're thinking about documenting climate change data. And Tom is leading a group that wants to really look into this question so we can benefit from the position we're in with CAT models, etc., to try and answer this question better in terms of it's not just hazard that could drive the change in the future.
Great. Well, Kirsten, I saw you nodding very vigorously there, so I suspect you have an opinion on this. And Jessica, welcome back. So Richard's point was your climate sometimes takes too much strong view just purely on the hazard, but we've got to also take account of the exposure. Is that, I'm sure that's something, well, it is because you said you do. Do you take account of in what you're doing with the way you're looking at how people are reporting to you?
I think it's something that we need to do. I think that we're so early in the journey of looking at the impact of climate change that there is a tendency to focus on the hazard because you can change one thing at once and see what the impact is. But I think we all know that doing a test where you have current day exposure and vulnerability and changing the hazard isn't really a good representation of what you would expect to see in a climate future. It's a good way of starting the discussion and, bringing people's attention to a very, very important problem. But I also sometimes worry that some of these outputs might get overused or have too much importance placed on them for what is something that is a very, very uncertain problem. As cat modelers, we always talk about we need to communicate uncertainty better, and sometimes we get better at it and sometimes we don't. But when we talk about layering climate change on top of that, we're talking a whole new level of uncertainty.
Yeah, well done. You actually answered two questions in one there, because that was another question around model uncertainty. But Jessica, I'm just going to ask that one to you as well, because that clearly, in your role at advising your clients about many things, including how to buy reinsurance. As Kirsten said, we've always had inherent uncertainty in modelling. There'll always be uncertainty in modelling. You add into climate change and that. How do you help reconcile that uncertainty with the ability to make a decision around what they have to do from a business point of view?
Yeah, absolutely. There's so many different sources of uncertainty as well, right? So we talk a lot about these RCPs, these representative concentration pathways, but we don't know what the future is going to be in terms of greenhouse gas emissions, right? It depends on economic development, technological breakthroughs, policy. So we don't know. So that's a source of uncertainty. And then let's say you've decided on your RCP, you decided what time horizon you want to look at. Well, the truth is that the climate models don't agree with each other, even very good models that are well respected. So you might take the HADGEM out of the UK, you look at the US model, they don't always agree on the sign, let alone the magnitude. So if you're looking at precipitation changes, you might have one model say you're drying and one model saying you're wetting. So what I encourage people to do is not look at only the multi-model mean. You need to look at multiple models to get a spread of the uncertainty. And I also say, look, we're doing order of magnitude calculations. Is my risk changing by 10% or 100%? Not, is it changing by 10% or 20%? Because we just don't have that precision.
Great. And you had another acronym there that I almost got but didn't quite get, representative pathways. I know that's not quite the full terminology, and I know it's well understood in sort of climate discussion.
Sure. It's RCP, so representative concentration pathway, and it's essentially some future projections, some scenarios that the climate scientists have come up with about how greenhouse gas emissions might evolve over time, because you need that as an input into your climate models. And some of them are more optimistic and some of them are more pessimistic.
Great, well, thank you for that. Matt, you were also nodding earlier about Richard's point around exposure. Just referring back to what Nasdaq is offering, are you sort of able to help manage this, both parts of this climate risk, the increasing exposure around the world, as well as the actual variations in the hazard?
Yeah, well, people can build their own models and put them on our platforms. So one way in which people could include that would be to take the hazard information from reask and put that together with their own views on how vulnerability might change, or build that into an OASIS-based model. And then they could host that model on our platform and use that model throughout their organization. So that's one way in which our platform could help with that. But I agree completely with what Kirsten and Rich just said, that most studies I've seen focus on the change in hazard because it's the obvious thing to do. But of course, you need to think about how mitigation and how vulnerability will change over time as well. But that's hard. And I also agree completely with Jessica that we're talking about order of magnitude changes. So that's really important.
Fantastic. Well, Nick, we just want to come back to you as things wrap up and make sure we let you get away and enjoy the rest of your evening. I do have one question for you. I think we haven't got through all the questions, although you've done a great job. Thank you, panelists, for answering almost all of them, or at least the sort of sentiment behind them. Nick, a question there about how is this going to play into parametric insurance? So, and I know you're doing a little bit of work in this area, parametric insurance, and what you're doing with reask and sort of general climate variability.
Yeah, absolutely. And look, parametric, obviously, from our perspective, is something that really enables us to really use our models to the absolute maximum, because we have much more of a focus on hazard and trigger. And what we'll be seeing in the sort of coming weeks and months is some announcements that we have around clients, specifically on the parametric side, both from from long-established companies, as well as this sort of new breed of startups in the sort of MGA space as well. But the answer to that question is yes, our approach is something that is very useful for the parametric approach to the sort of the non-indemnity based approach, because we have the ability to look into really understanding what the hazard is and how it is that we can measure the outcomes of that, and it's something that we're really excited about.
Fantastic. Well, as we are coming up to the hour, I'm just going to bring things to a close there. So thank you to everybody for that excellent contribution, all your help putting this together. Nick in particular, of course, thank you to reask for your support. We are also mentioning this area quite a lot in the location intelligence report, which you can get from the website. We'll be back on the 6th of May with a low code, no code event that Robin Mertens is going to be hosting. Yeah, big shift in how technology is being used in insurance. We will be making this available as well in various different ways, this event. So you'll get a write-up. You can watch the recording again if you didn't quite catch all those acronyms, and we may even find some other ways to distribute it to you. So thank you to everybody. Good night to Nick. Good morning to everybody else. And thank you to all of those of you who joined us.
Thank you very much.
Thank you.
Bye-bye.
Bye.
Goodbye.